Welcome to SOX System Reports testing. This has received a lot of focus by the external auditors and the PCAOB recently, so we want to talk about it and why it's important. So the reason why these system-generated reports are important is because management uses these reports to make judgments, to book journal entries, or to record financial transactions, and this impacts the financial statements. But even before we go through that, how do we know which system-generated reports are in scope for SOX, and what are considered standard reports? What are non-standard reports? How do we test them? What sample size do we need to use to test them? And what roll-forward testing should we use? So these are the areas that I'm going to cover today. So the first part is just even scoping whether the system-generated reports should be in scope for SOX. There are three criteria. The first one is, does it serve a financial reporting purpose instead of a purely operational purpose? An example is you could get a system report that shows you the system, the ERP system, uptime, the amount of time that it was working or available for any user is 99.9% of the time. That's great, but it actually has no financial reporting impact. It doesn't have financial implications for our results. It just says our systems are working. That's purely operational. Versus if it's a balance sheet, a trial balance, an AR reserve report, or an AR aging report, that has financial implications. The second criteria is, are these system-generated reports associated with a key control activity? So in your day-to-day running of the business, you will run into lots of reports, and in order to make sure that we scope and only look at reports for SOX purposes, usually it's because they're associated with a key control activity, such as the review and recording of AR reserve, the recording of inventory reserve, the recording of revenue recognition or revenue amounts or depreciation. Those are types of things that are associated with the key control. And then the other criteria is materiality, because even if it has financial reporting purposes, it's related to a key control, but maybe the amount that this report, it's very immaterial, we wouldn't want to test it. We want to scope it out. It's good practice to test it, but it's not required. I'm focused here on the key reports that we'd have to test. And so based on that, the reports would be categorized and tested based on their complexity. So there's the non-standard reports and the standard reports. And I'm going to describe what a standard report is. And once you have the standard report, anything that doesn't fit that criteria is non-standard. So let's dive into standard reports testing. The reports that are either have not been customized, or where the company or as a user, we don't have access to make changes to report, those are considered standard reports. An example is if you implemented a new ERP system like NetSuite or Oracle, and the trial balance is one of those key reports that every customer, every user has access to, and you can't change the logic of the trial balance, the original trial balance report. That's considered a standard report. If that's the case, then there's no testing that you need to rely on that trial balance report if your IT general controls are working. And the logic there is, if you can't access and change the logic of the report that's written, or the report's not been customized at all, and you had appropriate controls around it, there's really no changes that would have been made to that report after it was installed onto your system. Now let's focus on non-standard reports. There are two things that we have to test for non-standard reports. The first one is logical access, meaning access to make changes to the report. And so the thing that we rely on is that general IT controls around logical access are working. And if that's the case, there's no additional testing that's needed, because the access hasn't changed and there've been no People who are able to access the report are appropriate, and there have been no changes to the report. Now, we do need to test the integrity of the report at some point. The integrity of the report is the completeness, the accuracy of the report itself, and there are 4 ways to test the integrity. The first one is the results of the original user acceptance testing. Look at the evidence or the results when the system was originally implemented and the users wrote the requirements, the IT team wrote the report, and then the user tested that report. If the user tested that report and no changes have been made to that report itself, no additional testing is needed, that report has integrity or continues to have integrity. The second way you can test the integrity of a report is the logic review. You could actually read the query steps or the logic behind that report to see if it's appropriate. An example is an AR aging report. If you looked at the query language that said, take the invoice date, if the invoice date is between the current and 1 day overdue, then put it in the current category. If the invoice date is more than 1 day overdue and between 30 days, put it in the 30-day category. If it's between 31 days and 60 days, put it in that bucket. If you read that logic and the logic makes sense with what the report is supposed to do, that's all you need to do. The third way that you can test report integrity is called parallel simulation, or basically recreating the report on your own and comparing it to get the same results. If you create the report and you get the same results as the report that's generated out of the system, you know, however the system's doing it, you're both getting the same results, so it must be correct. And the final way is cooperative inquiry and watching the user actually generate the report. So you want to question, ask the user, do they understand the report? What's the logic of the report? What's the result that has to come out of it? And then you actually watch them generate the report and you verify the result that's supposed to come out of the report matches with what the user told you, in which case you can have now corroborated it. So the sample size for system reports is awesome. That's why so many people want to push for automated controls or system controls, and that's because the sample size is only 1. We know that systems always act the same way, so if we test the logic, we only need to test 1 report to know that it continues to operate effectively. During the roll forward testing period, which is basically the period since your last testing until the end of the year, what you can do is, as long as your IT general controls continues to work in the change management area, then there's no additional testing needed, right? We tested the report at one point in time. The change management controls that management has put in place is continuing to work. Well, then nothing should change on that report, or if changes were made, then there was good testing of it, then you can rely on it. If you find an exception in the change management process, because you're relying on change management, you have to look at that exception and evaluate it to see if you might have to do additional testing. One area where you may not need to do additional testing is maybe change management. If you look at all the tickets, the exceptions were around a particular system and that's not your system. For example, you could argue that they might have had bad change management for a particular area, a particular division, but the other divisions that your report is related to isn't impacted. Or if you can't argue that, then you may have to go back and retest using the 4 methods that we talked about before for report integrity and to look at logical access. And that's it on system reports testing. Hope that's helpful, and we'll talk to you in the next session. Have a great day.